In our video last week, which I'll provide a link to in the description below, we briefly spoke about the Japanese yen carry trade. We didn't have the time in that video to provide a detailed explanation of what exactly the yen carry trade is or how it works, so today we'll do just that. I hope you appreciate all the research that has gone into producing this video, and if you find it useful, I would be awfully grateful if you would share a like and follow in return. Thank you. So, in general, a carry trade is a popular financial strategy used by investors globally to profit from the interest rate differentials between countries. This strategy involves borrowing funds in a low-interest currency, such as the Japanese yen, and using those funds to invest in higher-yielding assets in other currencies. The spread between the borrowing cost and the return on the investment generates profit if executed correctly. The Japanese yen carry trade became especially popular during the 1990s and 2000s, driven by Japan's ultra-low and even negative interest rate policies when the country was fighting a period of crippling deflation. Specifically, in the yen carry trade, investors borrow money in Japanese yen, a currency that has had very low interest rates for decades, and convert it into higher-yielding currencies like the US dollar or emerging market currencies. The borrowed yen is used to buy assets in these other currencies, which offer much higher returns due to their country's higher interest rates. The profit comes from two sources. The first is the interest rate differential. Investors pay low interest rates on their yen loans and earn higher interest rates from the foreign assets. The second is currency appreciation. If the yen remains stable or depreciates, investors also benefit from favorable currency movements when repaying their loans. However, there is a risk of loss, especially when it comes to foreign exchange movements, which we'll come to later. The yen carry trade grew in popularity in the 1990s, when Japan entered a prolonged period of economic stagnation and deflation. In response to its economic woes, the Bank of Japan implemented an ultra-loose monetary policy that pushed interest rates close to zero, a phenomenon that later became known as zero interest rate policy. In 2001, the Bank of Japan took things even further by introducing quantitative easing, flooding the market with yen to stimulate lending and economic activity. Global investors quickly took advantage of Japan's low borrowing costs, borrowing yen at near zero rates to invest in countries offering higher returns. As Japan continued its low interest rate policies for decades, this strategy became a key part of global financial markets, and at its peak was estimated to account for approximately $1 trillion in assets. The mechanics of the yen carry trade are perfectly simple. First, an investor takes out a loan in Japanese yen at an interest rate of zero or close to zero. Second, the yen is exchanged for a foreign currency that has a higher interest rate, such as the US dollar. Third, the investor uses the money to buy assets that generate higher returns. These can be low-risk assets, such as government bonds, or higher-yielding but more risky assets, such as equities, or other financial instruments. Fourth, the investor will ultimately have to sell the assets, convert the dollars back to yen, and repay the loan, with any accrued interest, but keeping the spread between the amount earned and the amount earned. For example, if the investor borrowed the equivalent of $1 million at 0.5% interest, they would owe $5,000 in interest at the end of the year. If they invested the $1 million at 5% interest, they would generate $50,000 in income, for a profit of $45,000. It is also possible, if the value of the yen falls against the value of the dollar, that the investor would generate a second profit and would have to use fewer dollars to buy back the equivalent amount of yen. However, the converse is also true, and if the yen strengthens against the dollar, the investor's profit could be wiped out and they may end up with a loss. The primary participants in the yen carry trade were institutional investors, such as hedge funds and banks. However, some sophisticated retail investors were also able to participate, and was a profitable trade in Australia, New Zealand, and Brazil, where higher interest rates and stable foreign exchange rates made the trade very profitable. We can look at some examples of successful executions of this trade. George Soros, through his quantum fund, has been involved in various global macro trades, and the yen carry trade was one of the key strategies his fund used in the 1990s. During this period, Japan's interest rates were extremely low, and Soros borrowed in yen to invest in higher-yielding assets in emerging markets and commodities. This was a period of global economic growth, which helped drive up the value of the assets in which he invested, while Japan's currency remained relatively stable or depreciated, enhancing the returns. Soros' strategy generated massive profits during the global economic boom of the 1990s. However, as with many carry trades, it became riskier after the 1997 Asian financial crisis, when global markets turned volatile, leading to the unwinding of some of these positions. Long-term capital management, a highly leveraged hedge fund, engaged in carry trades, including the yen carry trade, during its operation in the 1990s. The firm took advantage of the interest rate differentials between Japan and other regions by borrowing in yen and investing in higher-yielding currencies and assets. This strategy initially helped LTCM generate high returns. In the years leading up to the 2008 global financial crisis, hedge funds and institutional investors extensively used the yen carry trade. Hedge funds like Bridgewater Associates and More Capital Management use the yen as a funding currency to invest in assets like Australian dollars, Brazilian reais, and US equities. In the 2000s, retail investors in Japan and Australia also engaged in carry trades using the foreign exchange market. Japanese retail investors, in particular, were drawn to high-yielding currencies such as the Australian dollar and New Zealand dollar, often referred to as Mrs. Watanabe trades. Mrs. Watanabe, a colloquial term for Japanese retail investors, frequently borrowed yen to invest in high-yielding foreign currencies. This became particularly popular among housewives and individual investors seeking to take advantage of global interest rate differentials. Many Japanese retail investors earned significant profits as they borrowed in yen and invested in high-yielding foreign currency bonds. However, like institutional investors, they suffered when the yen strengthened following the 2008 crisis. For balance, we should also take a look at some examples where the trade went wrong, sometimes spectacularly so. We'll rejoin our friends Long-Term Capital Management, who engineered a failure so spectacular that it not only bankrupted the hedge fund, but also came close to bringing down the US financial system and required involvement from the Federal Reserve, which was completely unheard of at the time for a single obscure hedge fund operated out of Greenwich. For the uninitiated, Long-Term Capital Management was a US quantitative hedge fund, quite literally run by rocket scientists. The fund was willing to take very small profits on a huge number of trades identified by its algorithmic trading program. And because some of the profits were small, and because the founders had such a high opinion of their own genius, they employed leverage. A lot of leverage. Really, these guys often employed a 25-to-1 ratio of debt to equity, which certainly helped to juice their returns when things went right, but when the market moved against them, they quickly found themselves in trouble. A lot of trouble. Long-term capital management was long on the yen carry trade, very, very long. The fund had borrowed heavily in yen to invest in higher-yielding currencies and assets globally, and things were going well right up until the point they weren't. The fund experienced initial success, generating easy, low-risk profits. That was until the Russian financial crisis erupted in 1998, and which caused global financial turmoil and quickly spread into an Asian financial crisis. The market turmoil caused investors to flee risk-on assets to safe haven assets, such as the Japanese yen. This caused the yen to surge in value and meant investors such as Long-Term Capital Management needed more dollars to repay the yen-denominated loans. Long-Term Capital Management's losses reached almost $5 billion and wiped out the fund. Other institutional investors were also caught up in the market turmoil. French bank Societe Generale also lost significant sums when the yen appreciated, and some of the assets in which they had invested depreciated in value. Several hedge funds were also caught asleep at the wheel, such as Highbridge Capital Management, which was not only caught out by the rising yen, but also because they had invested in risky assets such as emerging market bonds, which were now suffering significant falls in value. Even the retail investors, Japan's Mrs. Watanabe's, took a hit. As global financial markets crashed and risk aversion spiked, Many of the high-yielding currencies that Japanese retail investors had invested in depreciated rapidly. Simultaneously, the yen appreciated sharply, making it costly to repay yen-denominated loans. As the global financial crisis unfolded in 2008, the appreciation of the yen, combined with the declining value of the assets in which investors had invested, made it extremely costly to close out these positions. The sharp reversal of the carry trade exacerbated market volatility, causing steep losses for many. The financial turmoil also led to a reassessment of the risks involved in the carry trade, especially during periods of global market stress. However, after the 2008 financial crisis, driven by huge speculation in the U.S. housing market and which caused financial ripples worldwide, the Bank of Japan once again initiated an aggressive policy of monetary easing and low interest rates to stimulate the economy. This again stimulated the yen carry trade. Wall Street, never a place to be too concerned with lessons from history, quickly piled back into the yen trade and again set about making low-risk profits. And again, all went well, right up until it didn't. This time it only took up until the 2022 market volatility for the party to come to an end. The U.S. had implemented a policy of increasing interest rates to combat inflationary pressures, and shortly thereafter Japan followed suit. The Bank of Japan increased rates from negative 0.1% to positive 0.1%. Not a significant rate on a global basis, but enough to cause the yen to appreciate significantly, and again cause investors losses on the foreign exchange side of the carry trade. The rise in the yen's value triggered margin calls for investors, forcing them to sell off their speculative positions. This unwinding process led to large stock market sell-offs globally, as investors liquidated assets to cover their positions. As of mid-2024, the unwinding of the yen carry trade has significantly impacted global financial markets, particularly stocks, as investors have been forced to exit positions to manage their risk exposure amid rising yen valuations. At the same time, data from the Bank for International Settlements show that the value of foreign exchange derivatives involving the yen grew by 27% from 2021 to the end of 2023, reaching $14.2 trillion. This indicates that substantial amounts were still being borrowed in yen during this period, reflecting ongoing use of the carry trade despite the rising risks. At this point, any intelligent investor may be pondering, is it possible to engage in the yen carry trade and hedge the position to protect against such losses? It is certainly possible to utilize strategies to hedge or manage the foreign exchange risk associated with the carry trade, which we have identified as one of the biggest risks involved. A currency forward contract allows an investor to lock in an exchange rate at a future date. By entering into a forward contract, an investor can effectively hedge against the risk of unfavorable currency movements. For example, if an investor borrows in yen and invests in US dollars, they can use a forward contract to lock in the exchange rate for the future date when they need to convert US dollars back into yen. Similarly, a currency futures contract is a standardized contract traded on exchanges to buy or sell a currency at a specified price on a future date. They provide liquidity and transparency since they are exchange traded and help hedge foreign exchange risk by locking in exchange rates. A currency option provides the holder the right, but not the obligation, to buy or sell a currency at a predetermined exchange rate before or on a specified date. Investors can buy put options on the funding currency to protect themselves from its appreciation. For instance, if an investor has borrowed in yen, they could purchase a yen call option or a USD put option to hedge against the yen appreciating. A cross-currency swap may also be utilized. This is where two parties exchange interest payments and principal in different currencies. For example, an investor borrowing in yen could enter into a swap to pay interest in yen, but receive interest in the currency in which they are investing. The swap effectively locks in an exchange rate and removes the currency risk. Finally, an investor may adopt a process of diversification to manage their risk profile. Investors can reduce foreign exchange risk by diversifying their carry trades across multiple currencies. For example, instead of borrowing only in yen, investors might borrow in both yen and Swiss francs to spread the risk. If one funding currency appreciates, the losses may be offset by gains in other trades. All of these hedging strategies will increase the cost base of the trade and eat into the expected return. But the flip side is that an investor will still be able to sleep at night when the inevitable market volatility hits. Finally, and leading on from the diversification strategy just mentioned, we have only spoken so far about the carry trade in Japanese yen. However, it is possible to engage in a carry trade using various currencies. The Swiss franc has historically had very low interest rates due to Switzerland's stable economy and low inflation. The Swiss National Bank even introduced negative interest rates in 2015 to curb the appreciation of the franc, which made the franc a popular funding currency for carry trades. However, much like the yen, the franc's potential for rapid appreciation during global crises can make the trade risky. This fact was laid bare in January 2015, when the Swiss National Bank took a significant and unexpected action that caused substantial volatility in foreign exchange markets. The National Bank abruptly abandoned its policy of capping the Swiss franc's exchange rate against the euro at 1.20, a cap that had been in place since September 2011. This decision led to the Swiss franc appreciating sharply against the euro, with the exchange rate dropping to around 0.99 within hours, marking an 18% increase for the franc in a single day. The euro has also been used as a funding currency for carry trades, especially since the European Central Bank implemented its own negative interest rate policy in the aftermath of the Eurozone debt crisis. Interest rates across Europe remained very low for years, making it attractive for carry traders to borrow euros and invest in higher-yielding currencies, such as the Australian dollar or US dollar. However, it is interesting that the US dollar itself can be used for a carry trade. While the US dollar typically has higher interest rates than the yen or the euro, it has occasionally been used in carry trades during periods of ultra-low US rates, such as during the Great Recession of 2007 to 2009, and the COVID-19 pandemic. During these times, the Federal Reserve lowered rates to near zero, making it cheaper to borrow in USD and invest in emerging market currencies or commodities. The Hong Kong dollar is pegged to the US dollar, and the Hong Kong Monetary Authority follows US monetary policy closely. Since interest rates in Hong Kong are generally low, the Hong Kong dollar has been used as a funding currency in the Asia-Pacific region. Its stability, due to the peg, makes it relatively low risk for carry trades, though market disruptions can sometimes challenge this peg. The British pound has been used for carry trades, especially in times when the Bank of England maintained low interest rates. The pound's involvement is less frequent than the yen or the euro, but during certain periods of economic weakness or monetary easing, it has been an attractive funding currency. Finally, the Swedish krona has been used in carry trades, particularly during periods where the Riksbank, Sweden's central bank, maintained low or negative interest rates to boost inflation and economic growth. Sweden's ultra-loose monetary policy made the krona an attractive funding currency, though it remains less popular than the yen or euro. So there you have it, the carry trade explained, what it is, how it works, and the risks and rewards that could come along with it. If you've stuck with me this long, then a big thank you. I hope you found the video interesting, and I hope you'll join me for more of the same next time. Thank you.